Well, good afternoon and welcome back to our High Rock Weekly Client Webinar. If you want to skip over any part of this webcast, feel free to use the fast forward control on your screen. Otherwise, sit back and enjoy. And each week on this call, as you know, we try to talk about what we see developing in the global economy and financial markets and the world of wealth management, and how all of this impacts our decisions on the best courses of action for our and your investment strategies. I'm Scott Tomlinson, and joining us on the call today is my partner and colleague, Paul Tepsich, the founder of High Rock. Our certified financial planning professional and wealth forecast specialist, Bianca Tomlinson, has taken a short leave following the birth of her first child. We do expect her to be back in a part-time capacity shortly. And each week we record this webinar so that those who can't join us live can tune in when it is more convenient. If you're a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this, and all you need to do is visit the homepage on our website and click on the Introduction to High Rock Private Client button. Well, as you all know, our priority is to manage risk first and foremost, and currently we believe that we are in a time where investing risk is high and rising. We want to make sure that despite this, our clients have no trouble sleeping at night. So we are doubly aware of the current investing climate and all the many risks that are currently in play. It is extremely important to us that you understand the risk in your portfolio and how we are taking measures to protect you. And if you wish to discuss risk in your portfolio in more detail, very specific to your circumstances, please do not hesitate to get in touch with us. Well, volatility spiked a bit in August with the North Korea tensions. They spiked again today. And historically, September and October tend to be the most volatile trading months. Paul, any comments?
Well, you kind of said it all. It's really, in my opinion, all about North Korea right now, and and how China and the Soviet or Russia may respond. But maybe we'll talk a bit more about that later. But really, it's the volatility over the past couple of days, and certainly today being one where the Dow is down 1%, and government bonds are seeing a flight to safety bid today. It's all about Korea.
And you bring up the flight to safety. So we've seen bond yields come down, bond prices are rising, but stock prices until recently, especially in the U.S., have really not been following bonds, and that to me and maybe to you as well makes stock prices look awfully vulnerable, right?
Well, yeah, a couple things here, and I went over to one of our larger client, a very sophisticated investor. I went over to his house a couple weeks ago, and I just said to him, I can't reconcile what's happening in the stock market, specifically in the U.S., to what's happening in the bond market. And I think that this chart here, the last couple months, kind of says it all. And we used to say it, and we still believe it, is bonds lead all, government bonds lead all capital markets and securities. And the government bond market is telling us something here, but the stock market just refuses to pay attention. So I'm still at a bit of a loss here. And this investor I spoke with, quite frankly, he was at a loss too.
And in Canada, we've seen stock markets until pretty much most of this year. We've seen weaker equity markets in Canada. Bond prices have been falling, yields rising until very recently. And a lot of what's going on in the bond market has to do with what we're seeing, certainly in the Canadian economy. And we'll get a chance to talk about that a little bit later. But any commentary on these correlations at this point?
Well, in Canada, obviously, we've seen a stronger economy. We've seen the Bank of Canada raise rates and arguably may raise again tomorrow, if not tomorrow, then in October, ceteris paribus. So that chart there looks a little bit different than the U.S. chart. But I and we'll get into it in a bit in this deck later on, but the Canadian stock market, I think, by the end of the year will show better performance in the U.S. from today's date forward, and a lot of that will be based on the commodity markets having improved rather dramatically.
Okay, that's a great point. So let's we will get to that, and the last sort of risk factor that we have to take into consideration, certainly when people have globally diversified portfolios, and that's what the Canadian dollar has been doing lately, and of course making new highs against the U.S. dollar recently, and this is an important part of that risk equation as well, right?
Yeah, for sure. And I think part of the strength we've seen in the Canadian dollar over the last, 4 months now has come through the strength in the economy, the Bank of Canada raising rates and talking more hawkishly about raising them further. But a lot of that too, just commodities having improved. Now the price of oil not necessarily so, but again, we'll see it in the deck here shortly that a lot of these metals have improved dramatically, and that's helping the Canadian dollar as well.
Okay.
And then really balancing that out on the other side, on the negative side, is the Canadian consumer, which I think you're going to show a chart on, Scott. We'll probably get to as well, but that's more of a negative for the Canadian dollar at some point.
Yep. Yeah, we will get to that for sure. But back to our thesis of having a more tactical approach to investing and allowing us to not necessarily be relying on the old correlations, which, given the circumstances, aren't providing appropriate portfolio balance anymore. And this is why we believe that this more tactical approach is something that people should be focused on. But for the regulators, as we say each week, we have to remind everyone listening that historical returns are no guarantee of future returns. But as you know, at High Rock, we do work very hard to provide our clients with the best possible risk-adjusted returns. We also believe that it is very important that we review your wealth forecast on a regular basis with you so that we can ensure that your long-term goals are still in line with your portfolio strategy and that our forecasts for your net worth into the future are up to date and heading in the right direction. If you would like to review any aspect of your portfolio or wealth forecast, we want you to please get in touch as soon as you can. And speaking of planning, this morning's Globe and Mail, we saw an editorial from Canada's Finance Minister Bill Morneau on his view of why he wants to change the structure of corporate taxes and change the framework for those individuals who use corporations to pay lower tax rates. It is important to review your tax strategies and be prepared for what changes may be coming down the road. We want to be able to incorporate these potential changes into your wealth forecast and measure the potential impact.
So Scott, actually on that slide, I didn't get to it today, but I will do it tomorrow. But our auditor, Collins Barrow, they had a webinar last week I wasn't able to listen to, but there's a recorded version of it. I'm going to listen to it and see if we can come up with some potential ideas and where this is all at. But I think these are pretty major changes, and if any of our clients or any listeners are self-employed or they own their own business, corporation, this will affect us if it is put into place.
Yeah, so, and the one thing we, as always, we have to be careful of is that at the moment, certainly the finance minister is feeling out the circumstances and nothing has been decided. So we want to caution people at the same time to be patient and wait to see what exactly it is that is going to come down the pipe. Back to our themes for investing for 2017, as we do each time we talk. Our key theme, of course, is to avoid risk, especially when risk is high, and we think that at the moment risk is very high. That means being more tactical inside an investment portfolio, and we're obviously very vocal about that. Price stability is a mandate for all central banks, and the level of inflation or expected inflation is a key determinant for central bank policy, as is the liquidity that is in the system due to the recent years of extraordinary monetary policies. The Bank of Canada raised rates a number of weeks ago, as Paul said. They may do so again. The odds don't favor tomorrow, but certainly October at the latest. And the U.S. Federal Reserve has raised rates by 0.75% since December, may do it again at least one more time this year. And rising borrowing costs and reduced financial system liquidity may increase volatility going forward. As you all know, we believe stock prices and valuations are at close to their highs, but without more significant earnings growth, this leaves them vulnerable to correction. And the Trump agenda has so far failed to bring a new healthcare option, and it's impeded progress on fiscal stimulus. Now they have to deal with the debt ceiling increase. There's Brexit negotiations ongoing. Of course, there's the NAFTA renegotiation. We'll talk about that a little bit more in the program. Tensions with North Korea are back up, and there's always Russia and the Middle East as wild cards, as well as global cyber attacks and other terrorist threats, all adding to the blend of political uncertainty that confronts us on an ongoing basis. While the evolving inflation story was one of our important themes for 2017 as we try to assess the implications for central bank monetary policy and interest rates. And if economies are growing, inflation should be growing, but this does not necessarily appear to be the case at the moment. Now, all central banks have a mandate to maintain price stability. Interest rates and monetary policy are used to keep inflation at targets of about 2%. Currently, only the Bank of England is dealing with inflation above that level, but they are also dealing with Brexit and an economy that has stalled. Now, it is an important week with both the Bank of Canada and the European Central Bank making interest rate decisions. Let's talk about Canada. The headline news from last Thursday was that StatsCan announced that real gross domestic product in Canada rose by 1.1% in the second quarter, a bit of an upside surprise. Now, that puts the last full year of growth at a rate of about 3.7%. However, remember that this is pretty old news, as it was data that ended 2 months ago. Our job here is to project what comes next and make our investment decisions on what we perceive lies in the future. Now, we doubt that the recent growth level is sustainable for a couple of reasons. The second quarter was driven by consumer spending and exports, both of which are vulnerable to the most recent increase in interest rates and the stronger Canadian dollar. Paul, do you want to elaborate a little bit?
Well, yeah, we did talk about that when we looked at the chart of the Canadian dollar. I mean, one of the negatives for the Canadian dollar actually improving further is the amount of household debt. And by looking at the second quarter GDP, yeah, it looks like we probably spent even more, and we're fairly indebted as it is on a personal income, debt to personal income levels. And then exports, the other thing too about exports is there's a lot of uncertainty about global trade. So I'm not so sure that will give us third quarter growth like we saw in the first and second quarter. Plus, don't forget, and I've said it before, that Canadian dollar has improved so much, like over 10% in 4 months. That's a big, big move, and we call that monetary conditions have tightened enormously. So the bank may raise rates and tighten them further, but the currency has tightened monetary conditions in Canada rather substantially.
And that also will impact that export with a bit of a lag, the export numbers with a bit of a lag, right? Because it takes a bit of time for that stronger Canadian dollar to work its way through the export system. But in time, Canadian produce is going to get more expensive for foreign buyers, and that's going to reduce the export, the ability to grow exports. And at the same time, we likely will have, because of the stronger dollar, be creating more imported goods, and that also works against GDP.
Yeah, for sure. Good points.
And as we discussed in our last call, short-term bond yields, which are the gold line here, expecting a bank rate increase, are rising. But without any increase in inflation, long-term bond yields, which is the green line, are actually have been coming down. And we call this a flattening of the yield curve. Historically, when the yield curve flattens to where short and long-term yields are level with each other, a recession ensues. And if the Bank of Canada continues to raise short-term rates and household consumption and exports fall in the next couple of quarters, that would likely set the stage for at least a weakening economic growth scenario developing. Well, the European Central Bank meets on Thursday, and President Mario Draghi will express concern over the euro's strength, and market watchers will be looking for signs about the future of his asset purchase program. And that is pretty important because, Paul, you may have something to say on this as well, but as liquidity eventually is taken out of the system by the European Central Bank, there will be less money available to help promote asset prices. And that will mean that expensive assets are likely to be sold. And as we're going to talk about, I think, shortly, equity assets are quite expensive.
Yeah, that may be true. But the other side of the coin on that one is, like, I just read 2 articles last week, and both Scandinavian sovereign pension funds, and I think Norwegian Sovereign Wealth Fund is the largest in the world, and the other one was the Finnish Sovereign Wealth Fund, and it too is rather large. Both the lead managers on those funds said they're just long so much cash. Now, they built up more cash because they're somewhat negative in the short term, but both of them are kind of saying, if we see a drop of another 3 or 5%, they're actually going to reinvest some of the proceeds of their cash. So that's certainly what we've seen year to date. These sell-offs have been short-lived because there is still liquidity in the system, apparently.
Yeah. And in the U.S., last Friday's employment data was considered to be rather weak, and will likely preclude the Federal Reserve from raising rates next week. But we also, in the past, have talked about a recession indicator that we watch quite closely, and that is where historically the unemployment rate, which is the white line here, turns higher and intersects the 3-year moving average, which is the pink line. When that white line passes through the pink line, there has always in the past resulted in recession. And so this is something that, of course, we keep an eye on. It's still relatively far away, but the thing to notice is that it looks like the unemployment rate has kind of stopped going down, whereas that pink line, that 3-year moving average, is still moving from the upper left to the lower right. So it does make that intersection something more likely, but not for a few months anyways. We also are paying close attention to the global debt situation, but we're not going to talk about that too much today. Global debt is still at record high levels. We all know about that. We talk a lot about how equity prices are still expensive. Earnings are not expected to grow at a rate that will have kept pace with the rate of stock price increases that we've seen. To us, that makes stocks expensive. But Paul, let's talk about stock markets. And we're going to go through a bunch here, but I'll let you lead the way.
Yeah, I just thought we'd whip through some of these really quickly. I mean, Scott, I think you put in sort of the minus 1.4% in the Dow is just from their most recent high. Is that correct?
That's correct, yeah.
And that's just on a nominal basis, not a total return basis. So, I mean, we can just give our viewers and ourselves just a quick view of what stocks have done recently to get a picture of what's going on in the world. And if you look at the Dow, I mean, obviously it looks toppy. NASDAQ is kind of looks toppy as well, maybe double top or something. There's the TSX, and as I said, it's been battered. We're down minus 5.3%, basically, almost year to date. I guess our peak was in February, but we've been hit down pretty hard. And with these metals improving, that may actually give us some better performance. What else do we have? The DAX, the German Stock Exchange, down 6% in the past, 3 months. FTSE 100 is the UK market, down small. The Euro Stoxx 50 is the 50 top large cap companies in the year. Again, you can see it kind of mimics the DAX, but it's down 6.4% in the last 5 or 6 months. Nikkei, down 4.6%. I got to think it gets hit more, and there's the surprise, and there is the reason why I think some of these metals are doing better, which we can now look at. So that's the China 300, and there's some metals. Now, gold, I think, is a very interesting metal. One we really don't own any of directly. We probably have very small exposure on an indirect basis, but gold is obviously seen as a hedge against inflation, but also a store of value. And you can see it's sort of broken out here a little bit, or on the verge of breaking out on a multi-year basis. And I think that is just part of the flight to quality with what's going on in North Korea. What else do we have? Industrial metals. So this is more of what I was referring to about the metals. So in the top left chart, and apologies for the charts being somewhat small, but we put them all on one page. These have all pretty much broken out. Top left is a 5-year chart of copper. You can see where it is now. We're beyond a 2-year high. Top right is a 5-year chart on nickel. You can see we've kind of broken out and moving towards certainly a 1-year high, and I'm not sure we're going to hit a 2-year high yet, but soon. And zinc is clearly broken out to a 5-year high in the bottom left chart. And interestingly, in the bottom right chart, I included a chart on cobalt. That's a 5-year chart on cobalt. And why cobalt is so important to us, along with nickel, is because all of our clients at this stage own a bond called Sherritt International. And Sherritt owns, this is a way we're playing the nickel and cobalt markets. We owned a bond, a senior unsecured bond, as opposed to the stock of Sherritt. We own the bond. It was a safer bet. We bought bonds probably, let's look at my notes here, but we bought bonds, I'm going to say about a month ago. July 26th at 69 cents in the dollar, and they are 75 bid now without. It's got a pretty juicy cash yield of almost 12%. Now, class 1 nickel and cobalt are used in batteries, electric batteries. So you can just imagine with what's going on in the world of electric cars, how important this stream of production is for these car producers and any battery producers. And look at the price of nickel is just shot up enormously here. So I think, not nickel, pardon me, the price of cobalt in the bottom right, but nickel will start catching up. So we do have some exposure to those two commodities through an investment in Sherritt. Anyway, I think those are important to look at, and they do affect the Canadian dollar, and they will start affecting the TSX.
All right, thanks for that. That's great insight into some of our thinking. And of course, we do monitor what's going on the geopolitical front. And as I mentioned, there is a lot going on there. The Trump administration is still struggling to move its agenda forward and running out of time to raise the debt ceiling. And as President Trump said, it is a big week coming up this week. And according to a story in today's edition of the Globe and Mail, American negotiators are insisting Canada and Mexico will have to make all the concessions in the overhaul of the North American Free Trade Agreement, while the United States will not give anything up. That becomes a pretty difficult bargaining position, but we know that President Trump has threatened on a number of occasions to tear up the agreement. So we get a sense of which way he's leaning. We talk about protectionism and what that might mean, and in no historical sense has it ever been positive for any economic situation. So I don't imagine if NAFTA gets torn up that that's going to be a positive situation at all for either of the three countries. Of course, there's lots of saber rattling going on with regards to North Korea, and it seems to be just a war of who gets the last word. And after a little bit of a respite the last couple of weeks of August, we're back into it in full bore in September, and certainly it's impacting markets. And another hurricane in the works that looks like it may make it to Florida, and that could provide further economic issues for the U.S. And so we're obviously going to keep an eye on what goes on there. As always, we continue to try to do the best we can to get portfolio growth, but obviously risk is our first priority. And with risk being at such a high level, we are being very, very cautious with our portfolios and our models. And we don't want to squander anybody's money, and we have to be prudent. It's what I think you, our clients, are looking for. Paul, any final thoughts?
No real changes to the portfolios over the last couple of weeks. We've been offline with our webinar, so nothing that we haven't already talked about.
All right. Thank you. As always, we want to thank everyone who's tuning in, for taking the time out of your busy schedules. We have been trying to make this webinar more of a dialogue, focusing on topics that we think are worthwhile, trying to give you a little insight into our portfolio and how we're managing it. We certainly would appreciate any listener feedback or any other ideas of what topics you might like us to discuss. We will be back with our next update next Tuesday. Until then, this is Scott Tomlinson, and on behalf of my colleagues Paul and Bianca, we want to wish you all a great rest of the week, and we'll see you next week.